Hello and welcome. You're at the Economic Times, and my name is Ashutosh Sinha. The markets are booming, and how can we not talk about the markets, and particularly IPOs? IPOs have lately been the darlings for the market. Companies that have left something on the table with their IPO pricing for investors have been lapped up by the investors. And then there are companies that are listing overseas, ones which have considered and gone ahead with the listing in the US markets through the SPAC route, as it is called. In short, it's all happening here. So the Economic Times and SS&C Intralinks presents Going Public, Blueprint for a Successful IPO. So we're going to be talking about all the facets of an IPO and how can a company go ahead with an IPO. So if you're a company that is looking to list in the coming year, maybe, or even 2 years, what are some of those things that you need to do? What are some of those legal issues that need to be taken care of? What are some of the other regulatory aspects that need to be considered and made sure that you have fulfilled them? What are some of the other several issues that you need to take care of? You need to make sure they are completed and, well, not just ticked the boxes, perhaps raise the bar as well. So we look at all what it takes to go through the entire IPO process and look at various facets of the capital raising process. To talk about it, we have a team of experts and they're all very seasoned professionals. Vineet Surana, Associate Partner, Ernst & Young Associates LLP. Yash J. Ashar, Partner and Head Capital Markets at Cyril Amarchand Mangaldas. Abhijit Tare, MD and CEO, Motilal Oswal Investment Advisors. And Satyan Shah, MD and Head Investment Banking, Edelweiss Financial Services. Gentlemen, thank you so much for being with us. And let's move ahead and talk about something that's a very exciting time for the markets. And let me first invite Vineet Surana to give his take, maybe a little bit of a context setting and put things in perspective on what all is needed to be done to make sure that you're on the road for an IPO or capital raising, I should say.
Thank you, Ashuf, and it's a pleasure to be here. Thank you to the Economic Times Interlinks teams for setting the session up and bringing one wonderful audience all together. It's been a year of IPOs, for sure. The number of IPOs this year has 3 times the activity what we've seen in 2019. Right? The amount of proceeds which have been raised, again, 3 times what we've seen in previous years. Globally, if you look at this SPAC activity, about 1,400 SPACs till date, but out of that, 62% of them have happened in this year and previously. I could go on and on in terms of facts, but as one of my friends recently joked with me, he said, Vineet, it's IPO after IPO, allotment after allotment, but all I'm getting is refunds. So there is a huge amount of activity, and the frenzy is unprecedented to that degree. Let me share some thoughts in the context setting in terms of what's the IPO journey like, what are the key areas that really come together, and some of the advices that really are required. I will allude to, Ashu, in my words, in terms of really setting the context of an orchestra. It's really, bringing all parties together. You've got the investment banks, you've got private equity, you've got legal counsels who are responsible for writing the document, you've got RT agencies, marketing, the company itself at the core of it, and it is a transformational journey. We all need to operate in harmony to bring that music and to many start off a new life altogether. In that kind of context, the IPO journey is broken down into 3 key phases, if I may put it that way. First and foremost is the preparation stage. On the very left-hand side of my screen, as you'll see, I've highlighted that in green as terms of key long lead items. That preparation stage involves, first and foremost, whether an IPO is really the right decision for the company itself, right? Should we be thinking about alternative sources of funding or not? Followed by financial statements, the 3-year track record, bringing the track record performance of the company and what could therefore future projections be as well. Followed by board and governance, the independent directors, the quality of the helm, the tone at the top, bringing together the legal diligence. Is the right legal entity structure? What about the capital and the tax implications of the same? Which market should a company really list at? Right? All of these are key preparation questions that must be answered and prepared for before beginning. Really kicking off the journey itself, at a minimum, to get the money in the bank account at the very right hand of the screen itself, it takes about 5 to 6 months at a minimum to get the money in the bank account. So the process is intense. There's a lot that's happening in the process in terms of the filing with Sebi, getting Sebi comments, doing roadshows. There's no taking a back once the process kicks off. So the real advice is start well prepared, make sure it's done, and I'm sure we'll hear more as the panel progresses. So thank you for that. Ashu, over to you again.
Okay, so 6 months. A lot of companies look forward to those 6 months because it's a life-changing thing for the company if they manage to go ahead and set the ball rolling and maybe look for the end of that minimum period of about 6 months that Vinny talked about. Let me ask Yash first. Yash, some of the legal things, the big picture, when you are clear in your head that you want to sell some part of the equity, minimum 10%, depending on what kind of a company it is. What are some of those broad legal things that must be kept in mind? And then, of course, we'll come to the details later.
Sure. Thanks, Ashu, and Economic Times and Intralinks for having this and for inviting us. Much appreciated. In terms of the legal, there is a bit of legal and there's a bit of governance. So in terms of the legal preparation, an IPO, the start of work on an IPO is in its own way the end of a phase of the company where the company has gone through potentially mostly several rounds of private equity, has had investors, has matured a bit, and has already set in place a structure where it has a CFO, a company secretary, a head legal, and a whole lot of other people who've already been reviewing some of the aspects of the company. We have had, and just as an aside, there was a transaction which we withdrew from at the last moment because they couldn't find their board minutes just before filing the DRHP. So that's also happened. So in terms of prep, when we enter, we expect that there is some amount of discipline and professionalism which has come into place. And a lot of private equity now spend a lot of time on that when they enter a company. Not to say that it doesn't happen before, but private equity has its own sort of requirements and it ups the game on some of the governance aspects. But our regulator is unique in that way, and our regulations are fairly unique. We are one of probably the only markets in the world where the first filing with Sebi is a public filing. And because it's a public filing, it's not like you have an opportunity to make many changes. The regulator says, I'm reviewing this as a whole. So all your sort of legal issues have to be dealt with upfront. Your governance in terms of your board construct, independent directors have to be in place. Your financials have to be compliant. And now there's been a recent guidance that has to be indexed. Your entire structure in terms of your capital structure, that usually ends up being the most painful part in an IPO. The build up, because Sebi says, I want to know from day one of your existence till the time you come to me, how did you build up your capital? When did you allot shares to whom, etc. The recent phenomenon which we are seeing is a lot of companies approaching the markets as being promoterless. So how do we reach that conclusion? That analysis of what are the key parameters by which we can conclude that there is no identifiable promoter, that the company is professionally managed. A lot of this has to be done in the green period, which Vineet mentioned. It could be a 3-month period, it could be a 6-month period, but that preparation and that going to, all of this is required, by the way, under the regulation. You have to be able to convince Sebi that there is nobody who can lock up 20% and you're approaching them in a promoterless manner. Nobody controls the company. We've had also a very interesting phenomenon over the last 12 to 15 months, 18 months, I would say. We used to have Maruti Suzuki, we had Tech Mahindra, we had a couple, Gujarat Pipavav, we have a couple of joint ventures, but the last few years have seen so many joint ventures approach the markets in the insurance space, in the asset management space, in the general insurance space. So now we have a bunch of joint ventures. What is the discipline between two joint venture partners after the IPO? So this is a very important question. So the discussion on that, the analysis, and again, the regulator over the last 3 to 4 months has clarified its stand. So as I can say, there's a lot which is in the regulation. There's some part which is governance. There's some part which is practice. But the expectation when we file the draft document with Sebi is one of completeness. Why? Because one, it's public, and two, the investment bankers file a certificate. They take liability for the document even when there's no investor. So with that background, I think that sets out, and there's of course the SEBI regulations, there's Companies Act. If you're in the financial services space, there could be NBFC insurance regulations to comply with. There could be requirements to file approvals with RBI, IRDA. And if there are other sectoral issues, we've had defense companies with peculiar issues to deal with. We've had companies in the e-commerce space, which again require more analysis on are they complying with e-commerce requirements. So there is a basic and then there's overlay depending on the company and its businesses. But I don't know, Ashu, if that answers your question and you want to.
Yes, it does. It does. And, it only opens up even more questions because we'll come to the detailing part as you pretty much expect someone like Yash to talk about the detailing, because that's where the lens they look at. And of course, markets is a completely different beast and they look at it in a completely different way. So Abhijit, this rush of IPOs that we're seeing lately, what does it mean for your workday? Sometimes maybe spilling over to the evenings and hopefully not too late. But tell me, how is it different from the IPO rush that we've seen earlier, or is it different at all?
So I think, and I was mentioning to you guys little earlier that, after almost 8 years of stagnation into the corporate profits, for the first time, we are seeing that J curve is getting completed and now they're on the cusp of that, real profit earnings growth. And because of which what has happened is not the companies from the metros and tier 1 cities, but a lot of companies from the tier 2 cities have reached to a critical mass of the profitability and the revenues.
Mm-hmm.
And so 2020s, actually 2015 onwards, the information arbitrage is just not there, because on the click of the button you get all the information. Now it is the perceptional arbitrage and the aspirations are flowing all across. And the aspirations that you and me see here sitting into Mumbai or Gurgaon are the same aspirations that people sitting into Kanpur, Lucknow, Junagadh, and all other tier 2 and tier 3 cities are also seeing on the TV and aspiring to become.
Mm-hmm.
So from that perspective, it's actually opened a lot of what do we call eyes of people who are sitting into such tier 2 and tier 3 cities, where they know that they have grown the business, but they really did not know how to monetize it.
Mm-hmm.
And suddenly this IPO rush seems to be a great way of monetizing the efforts that they have put into their businesses over the last 20-30 years.
Mm-hmm.
So from that perspective, it is a complete different arena who is approaching to us and discussing things.
Okay, so that's very interesting because it only kind of gets me to think about what one has read about in my favorite sport, cricket. So a lot of the cricketers are coming from the non-traditional centers, the tier 2 cities. So something like that is possibly happening in the markets as well.
Absolutely.
Okay, Satyan, how do you read the emerging situation in terms of the same question I'd like to ask on the opportunities that are emerging and the kinds of companies that are coming to the market?
So hi Ashu, pleasure to be here. So I think maybe I'll start with, yes, this has been a record year. We will definitely, a lot of records have been broken. And I just wanted to set some context there that, this has probably, as we speak in the calendar year so far in 10 months, we've done around 1 lakh crore of fundraising through IPOs, near about. This is probably the highest in a decade in India. And when I was doing some analysis, what we saw is that, there's this whole conversation that there is a mad rush, or is there a mad rush for IPOs? Well, in Indian context, I would still not call it mad rush. Yes, there have been bunching of IPOs and you are seeing a lot more IPOs than say some of the earlier years. But just in perspective, India saw 47 IPOs this year in this calendar year, raising close to 1 lakh crore. And just look at US as a market. And I know there are different markets, but US in this same period has seen around 900 IPOs, raising over $300 billion. Okay, this is the same period, the same 10 months that we are talking about. So if this is a mad rush, then I don't know what I'll call that, but that is there. Yes, I think Indian markets, to answer your question specifically, there has been a big liquidity. Okay, we've currently seen Indian markets flush with liquidity, both global from the FI side as well as domestic. Interestingly, in the last 1.5 year, you, in addition to the strong domestic liquidity that you always saw on the mutual fund side over the last 3-4 years with continuous SIP flow coming in, you also saw the emergence of retail liquidity, and that has been more a last 1.5 year phenomenon, especially once the pandemic had struck and people were at home. The kind of demat account openings that you have seen, and the kind of retail participation that you've seen in the markets. So there has obviously been a lot of liquidity, and what that has also led to is this constant need from fund managers, from investors to look for new ideas. And new ideas could, again, the rally initially would have started off with X sector or Y sector, and then it spread to the next sector, and but that's what has happened in the recent times. You've seen the entire digital space, and again, I do believe one of the beneficiaries, if I were to say, of the pandemic, or one of the positive things that came out of the pandemic, especially, was for, say, digital or new age companies. You had companies that were historically never looking at online sales as a channel, suddenly realizing in the lockdown that, look, if I have to do sales, online is a great medium. And today, when the lockdown has been opened up, all of them are in what we call omni-channel of distribution, where online plays a big part. And similarly, on the consumer, there have been consumers who never used to trade online, or when I say trade, never used to buy online, never used to order online. And the pandemic again forced them to do that. But what it has done is the pandemic acted as a big catalyst for that. So there has been a lot more converts into online than what the normal organic way would have been. But that's led to a big appreciation of what the digital world holds, and the kind of underlying growth that India as a country is currently offering for that. So one of the sectors, which are new or which have traditionally not been very active in Indian markets, have been the new age companies, because it was always perceived that would Indian markets be mature enough to rightly value companies that are not yet profit making. How would markets take that? And we've had a few successes that we've currently spoken about or seen in the market, but there is currently a big surge for new age stories to come. And it's also this whole belief that there will be huge underlying growth in those companies, because of which there is so much demand for those kind of stories. But yeah, I think liquidity has definitely resulted in investors constantly on the lookout for new stories, and I do believe that IPO is a great way for investors to come and participate into companies, into new stories, and be a part of their growth story in the listed world. It's a great time for them to invest.
Yes, it certainly is a great time to invest. So since we spoke about the liquidity part of it, and I'll just come to the regulation part in just a bit. Abhijit, usually the way market perceives it, once the liquidity is there, you do expect the fundamentals to change. So for a long list of companies, particularly since we spoke about the second run, companies from the second run cities, has that fundamental shift, or is it beginning to happen, or is it a better part of it is unfolding now?
So two things have happened with India incorporation per se. One is the demonetization that happened resulted into a lot of money that was stashed into the cash market coming into the formal economy. So actually that is the beginning of the flows that started into the equity markets through mutual funds. And going forward, what has happened is because this money was moving into the equities market, and there was the banking interest rates were going down, real estate was not really coming out to be a great investment opportunity. So lot and lot money started chasing less and less offerable and investable opportunities into the equity market. So so that was one point. Second very important point is that at 1.45 billion population, we are at $3.1 trillion economy. So our per capita GDP is $200 per person. At $200 per person, roti kapda makan is taken care of. and everything after that is a discretionary. And equity investment or investment in of any format is actually starts getting into that J curve post this $2,000 per capita GDP into any other economy in the past also. So two things have happened with India. One is the demonetization resulting into the informal economy getting into a formalized way. And now this 2000 per capita GDP crossover resulting into a humongous deluge of money that is now going to be chasing the discretionary investment or spending, whatever you want to call it.
Okay. So to guide these companies, Vineet, and also not just to guide, but also to make sure that there are very clear set of guidelines. How has regulation changed, and how has regulation made it possible, if I were not to use the word easier, for companies to tap the market?
No, Ashok, I mean, great question. I mean, typically what we've seen, and if I look at it in India over the last few years, there's a lot of enablement as well that the regulator has brought about. I mean, one simple example could be historically a few years ago, there used to be 5 years of information in terms of financial information that used to be included in the document, right? It's no longer 5 years, but it's only required 3 years, right? Our accounting standards, right? That itself is kind of more migrated towards the global IFRS accounting standards. Right? If you look at the recent discussion papers by Sebi, right? Some of them are still open to that degree in terms of promoters, the amount of institutional investors, the amount of anchor investment that would be allowed, how long should an anchor investor hold into the company, right? The governance per se, right? Allowing or rather mandating, women independent director to be on board, right? The composition of the board of directors, right? Moving towards, the quota committee recommendations and how many of them have been implemented in terms of board structure going forward, making sure there's more independence, there's more governance. I mean, one of the questions in the chat room, I was just having a look at it, is how do we protect money of investors, right?
Correct.
Right. And that kind of boils down to the governance, right?
Yeah.
Right? It's about investing in the right quality of companies and not being in the mad rush for the same. Really understanding it and not just investing because somebody's asked you to invest in the company. Right? You take it forward into the directionally where it's moving, right? From climate change through to the environmental, social, and governance. Right? There's more and more reporting that Sebi is wanting on that, right? Again, in the right direction, right? The business sustainability and reporting standards, right? Applicable to top 1,000 listed companies. So directionally, I think the governance is moving better. The risk and controls is coming together. The financial statements is there. The law firms are, doing a lot of good work on the diligence that they're doing. Right, the banking syndicates again working with the domestic as well as the international cohorts. Right, I mean, in a nutshell, it is no longer the India that we knew at one point in time. It is actually a new horizon. Right, many of the large tech companies that we're talking about, a few years ago would have thought should be listed in an overseas market. Right, but they now changed direction and they're listing, and not just listing but successfully listing in India. So to me, it's all coming together into a much more positive environment. And so precluding to the earlier discussion, Ashu, the other point I would like to add is what's happened a year ago, right? I mean, if you look at it more globally, like China, for example, I'm not going into the China-India debate, but one of the points that I've noticed is when Ant Group was looking at an IPO, right, the Chinese regulator came down really hard on them, right? And that kind of directed some of the global investors towards the next type, which is India. So the prominence we're getting not just on the manufacturing and the government schemes on PLI, but also on the investor money, right? For every $1 that's being invested in China, about $1.50 is being invested in India, right? That's what Ipos suggests. So to me, it is a good market. It's again, investors need to be careful about where, especially the retail investors, in terms of, because it's about growth capital versus exit capital. Right? So that's the way I would look at it, Ashu.
Sure. So Yash, for companies which are looking to tap into the markets, then what are some of those? So you did mention some of those broad features. Now, given the heady times that we are in, given the froth, some would like to believe there is in the market, how should companies be careful that they do not, if that were to be one of the considerations, give away too much of the equity just because it is fashionable to do an IPO, fashionable to raise capital? What are some of those things they should keep in mind for that?
Sure. So I think there's two parts to your question. I think at one level, you want me to address what's the sort of way to do that, and secondly, the size of an issue and how much to exit. So interestingly, yesterday, Sebi has issued a new consultation paper where they've regulated or intending to regulate how much you can sell. So if you own 10%, Sebi is saying you can't sell more than 5. That's a proposal, and one doesn't know how it'll go through, but that's interesting. But just to come back to your larger question of protection of investors and also balancing out volatility, etc. So I think so it's a fairly complex question, and I think some of the answers lie in what Satyen does, which is help companies do the valuation, which fortunately or unfortunately I have no expertise. But in terms of how the companies are preparing today, I think there was a very interesting conference I attended a few years back, and we had somebody down from, I recollect it was the NASDAQ or the NYSE, and someone asked him a question saying, if a company is preparing for an IPO, what is the one piece of advice you would give them? And I think that one piece of advice, if any company wants to do an IPO in the next 12 months, 18 months, 24 months, should think about, is prepare financials every quarter. That is the one point we think on every deal that companies today are struggling to get their financials in a shape by which they can get it ready and present it. Changes of accounting standards, plus just the discipline of preparing it in a timely manner. Because internationally, you have to list within 135 days of the date on which you're presenting accounts. If you're presenting March 31st, then you have to get it done by August 14th and so on. Similarly, the Indian accounting guidelines have prescribed similar restrictions, mostly followed by all the big four. So that, I think, is one of the key features which has to be undertaken by all Indian companies who are looking at doing an IPO in the foreseeable future. In addition to that, appointment of right personnel, because we are seeing companies approach us where they have not yet appointed, say, a full-time company secretary, or they're using company secretaries, because to my mind, from the new Companies Act of 2013, the role of the company secretary and her or his team has become critical to the success of a listed company. Our country has become very heavy on compliance and reporting, and the company secretary and her team do a fabulous job at it. So I think companies have not spent, it is being penny wise and pound foolish in all honesty. So not invested enough in that, and that builds up the discipline. Again, another fascinating insight is globally, company secretaries report to the board. In India, company secretaries end up reporting to the CFO or to the head legal. So you already constrained or chained up your company secretary in its own way. The board should have direct access to the company secretary so that the board can get a lot of information. In fact, when we look at structures and we see that, in India, we like, a structure where there's one or two people and then everything below. That also sometimes creates that, because most of the unicorns, for example, are largely flattish structures going up to the founders. But I think we are seeing in the last 12 and 18 months, fascinating structures of corporates, the old industry versus the new. So you're having an IPO of a company whose group is 50, 100 years old, they follow a certain format and discipline. You're having companies which are 8 or 10 years old, how do they approach it? How do they take decisions on ESOPs and other things? So I think there's been a fascinating learning for us as an industry, of lawyers, how we approach it, how we advise. And again, another huge aspect is how the business is drafted. I don't know if investors have actually spent a little bit of time on reading the business sections of recent documents. They are drafted a bit differently than they were, say, for 24 months back. So I think it's important for people to read the first few pages of the business section. And if you can't understand that, don't invest, right? Don't just go with the flow. And I know many people would say, "Isme to paisa banega hi." So I think sometimes, and this is advice I give to my team and to others, saying that, assume my father was investing, and I advise him not to mostly, but assume my father was investing. Would he be able to understand the document reading the first 3 pages, which is the overview, strength, and strategy? How can you explain this? The first few risks, what are the key risks of a company investing in that company? I think many people who are investing today are not reading the risk. We get calls saying the company is making losses, but if you read the first risk factor of these companies, it says We have been making losses for many years. We expect to continue to make such losses. So if people don't read that risk factor and they invest and they complain that there's a loss, then it's nobody's fault but theirs, right? So I think people obviously are very happy to go with the flow and, try to make money without actually understanding the risks. There are upsides to equity investment. There are also equal downsides. So I think it's important that people read the document. Lawyers like me are paid fair money to work on that. And, people like Vineet, Satyen, all of them expect us to do our jobs, and Abhijit invests on the hope that we are doing our job. So I think that is something we are not seeing investors spending enough time. People asking questions in the Q&A. I think this is the base answer. Please read the offer document. If you don't understand it, there are other avenues to invest your money. And I know, Ashu, this is going against the principles of the session today, but I think it's important to convey that going public means people who are investing and the public are actually reading what has been prepared for their benefit,
Sure, very, very valid point, I think, Yash, you've made. Just to remind, so there are some questions also coming in. So if you're watching this program, if you're watching this broadcast, it's very important that you ask your questions to the experts here from the market, from regulation, from advisory. So every aspect of your questions or your possible questions could be covered. So please do put in some questions. There are some coming, but I'll come to those questions as well. Just to go to Satyen on the next point that we said, some of the points that Yash mentioned, how do investors perceive that? Do they go through each one of them? I'm not talking of the big bulge investors. I'm talking of even slightly the HNI kinds.
So yes, I think see the DRHP, you could be lost in it. It's a big document. It's 500 pages plus. So I don't think you would expect a normal layman investor or even an HNI investor who's going to study it to go through 500 pages. Especially in times like this where there is so much happening. But yes, I think what do they base their decisions on? Definitely risk factors is something that they would all definitely read. Okay. But, one is the company good? Is it something that is it the right industry? But how do I, decide what is the right price? So if you ask me, what are the 4 or 5 factors that determine what is an investment that one would like to make versus what is an investment that I will not make? The way investors look at it. So one is, at least the 4 or 5 big factors according to us. One is the industry that I'm operating in. What is the addressable market? Or, there is a term that they call TAM, which is the target addressable market. Is it large enough? Which basically reflects that is the business going to be scalable? Can growth come in? Is the underlying industry a high growth industry, or it's an industry which is past its prime in terms of growth and it's going to grow at a steady state? So the industry that you operate in, what are the various players in it? Is it a monopoly or a duopoly kind of industry or there is a high entry barrier in the industry, or what is the competitive edge or moat that the company has? That becomes a second important factor to know that would it be something that there are multiple people able to do, or is it something that is unique to you or the 2 or 3 companies? I'm not saying unique means only one company can do it, but are there 3 or 4 leaders in a particular industry who will get most of the market share and therefore most of the growth that industry will throw up? Management quality, governance, and Yash touched upon some of those aspects, I think are very, very critical. And what is the other big thing that we look at is what is the visibility, predictability of earnings? Is it something that is it a business that very difficult to predict, whether the next quarter or the next, year is going to be good or bad? Or are you in a steady state business where it is easier to predict and therefore visibility of revenues is high? Because if the predictability quotient is not there, you will never know as an investor sitting outside what is in store for the management, what is in store for the company in terms of next year's, opportunity. So visibility or predictability of earnings becomes very important. And the third aspect we look at is sustainability. So scalability, which is your addressable market, predictability, which is your visibility, and sustainability, which is, we've historically many times seen companies making X margins, at a certain size. But the minute the company becomes in public domain or as the company gets larger, are you able to sustain those margins? Obviously there is always a disclaimer that what you have done in the past is nowhere a reflection of what you're going to do in future. But these are important questions to answer. Management quality, I'm repeating it, is of utmost importance. People have to get comfort that, look, at the end of the day in India, you are backing the team. So if you feel that the team there is something which is amiss, something that is not good, you will look at various factors, right from audit team to who are the legal counsels working on it, to what are the kind of litigation that the company has. There are companies in India who in the litigation section also have absolutely no litigation against them, which is also reflective of the kind of management and the organization that they've built over the years. That over the years, if there is very limited litigation that is there, or there's practically no litigation, it reflects the kind of management and the governance practices that are there. So it's a combination of a lot of factors. It's no longer a single thing that will determine what to invest or not to invest. But and some of these factors go into valuation also. Obviously valuation it's a price discovery process that happens with the institutional investors. See, amongst the three categories of investors, and I'm just going to a very basic rule in an IPO, assuming that most people will know it, but there is a QIB part to the book, there is a retail portion to the issue, and there is an HNI portion to the issue. It is the QIB portion, or the QIB investors through which the price discovery process happens, with whom the management actually do one-on-one meetings or group meetings. Basis their feedback, there is a consensus derived on how we want to price an issue. And so that category becomes important for pricing the issue. And most of the pricing of issues that you've seen, many times we get asked questions that, is this very high, or is this I can only tell you that any time an issue is priced, it is based on feedback that one gets from investors. Because if investor feedback is not there at a price, why would anybody price it at that particular price point when that there are no investors willing to subscribe? So there is a lot of lot of feedback that is built into any time a pricing is decided or price range is decided for the company. One more thing, Ashu, that I wanted to just touch upon. You asked earlier when Vineet, when you asked Vineet of some of the regulatory changes that have happened, and I just wanted to add one piece out there, that I do believe that with Sebi as a regulator is an excellent regulator that we have. They've been very proactive. Some of the measures that they've taken with an overall improvement of the process of reducing timelines are very, very commendable. There was a time where allotment process at our end used to be a very long drawn process. Once you applied, you had to put the money, refunds would come up, there was a 10-15 day period. Today as we speak, the money doesn't leave your bank account. Your bank account just gets blocked. So this whole thing of refund not coming or refund getting delayed, everything has gone away because of the regulator, because of the new regulations at play. And similarly, the process of allotment has been cut down significantly. Now 7 days from within less than 7 days from the issue closing, the allotment is done, that the money is released, and you have a listing which is done in less than 10 days. So, and obviously a lot of other stuff that the regulator has done. I'm not getting into those details, but I must say that over the years, if I were to compare to what India was even 10 years back or 5 years back to what it is now, we've made a lot of progress in terms of regulation.
Yeah, I can remember the 2006 period when the irregularities happened, and that forced the change. And good that it has changed for the investors. Definitely good. And in terms of the time being crunched and all that, good that has been happening. Abhijit, when you go to companies, what do they want to know from you about the entire process? Can you give probably one or two examples without naming any companies on what are the typical questions that companies from those, and I'm hung up on that tier 2 city companies, because if they are bold enough to go and list, it does tell you about the companies of tomorrow.
So while, and I will take the same example of tier 2 cities companies, while they have these aspirations to, monetize some piece of their efforts of the past, they are really not prepared in terms of the compliance, because going a IPO way is like a metamorphosis, a caterpillar becoming a butterfly, and where once you become the IPO'd company, the compliance cost goes up substantially. And when I'm saying compliance cost, it means like Yash mentioned, the having company secretary, like Vineet mentioned, having a formal CFO. Satyan mentioned that maybe having a formal IR agency, taking yourself to the street and talking about your quarterly profit. Someone also mentioned about having quarterly profit, quarterly results being
financials. Yeah.
So all of those things are still not there. So, while the the aspirations have already built in, they want to go walk that path, but actually the steps are not there. It is still a pagdandi.
Hmm.
So, largely the efforts when we meet this company goes into actually creating those steps for them to walk up to the IPOable company and then thereafter start the process. So the bulk of the process is not getting their accounts in order, getting their INDAS restated. It is less of that effort and more of getting them into shape and format where they can be IPO.
Hmm. Hmm. Okay. Okay, we'll also go to the questions. So some of them are coming in. So let's just take some of the questions that are coming in. This is Jaydeep Chatterjee's question, and Jaydeep says, it's been observed that joint ventures make more delaying tactics in issuing debentures and bonuses in time than the firm owned by the sole, than the firm, I suspect, owned by the sole proprietor. I'm not sure what exactly Jaydeep is trying to say, but basically JVs. Yash, would you like to comment on that?
No, if I understood the question, Ashu, if I understood the question, JVs are obviously more complicated because there are two sets of large shareholders coming from very different backgrounds, and there could be a combination of one Indian and one international. We've seen that obviously there is a benefit to it, but it's mixing of two cultures, mixing of two styles of work. So decision making is something which gets debated more as to what's the best for the company, what's the best for the industry, and how do the shareholders like to see it. So there's obviously a fair landing. I'm not sure if it results in delays in the sense that Jaideep is indicating, but there is much more. It's different from a company run by one promoter who's taking a decision, or one major shareholder versus two major shareholders wanting a debate. So I think there will be differences, and there could be good results at times and sometimes questionable results. But I don't think it necessarily, as I said, means delay. You have an opportunity to have the best practices followed in other jurisdictions come into India. So I've seen a lot of JV partners, for example, put in very high governance requirements, very high ESG requirements, very high requirements of who they want on the board. So I think that benefit you can't lose out from. And on the other hand, there could be fantastic Indian promoters who are able to take a lot of decisions, or sometimes we've seen some of our biggest scams on some of these companies where Indian promoters have come down from their high holdings to 2%, and they've continued to enjoy vast benefits without a check and balance. So there is, as I said, a check and balance, and there are ways in which JVs can do better, and sometimes it could take more time.
Okay, Satyan, there's also a question from Prapti Zaveri. And Prapti says, in an industry where there are no listed peers, how do investors view that? In terms of, I guess, Prapti wants to understand, how do you value that? Reminds me of Airtel when it listed in almost 20 years ago, where there was no listed peer, and they got a premium for that.
No, I think it's a very fair question. See, what happens is if you don't have any listed peers in India, one simple way, and many times that is also not available, is to see if there are listed peers in the same industry which are available in overseas markets, just to see that again the profiles will be different. They may be of a different scale, they may be of a different growth, but you will look at if are there listed market peers in the same industry in overseas markets. So when I remember we had taken one of the exchanges public in the past, and there were no exchanges in India, and the only listed peers were thankfully exchanges globally. There are multiple exchanges that are listed. So that served as a good benchmark point for people. We've had cases where there are companies that go public and there is no immediate directly comparable player in India because it's the first of its type company that has gone public. Now what do you do is you will still try and basket it into some industry which is comparable. So if and we see this many a times in what we call the classic consumer discretionary kind of segment. There may be an area where it's the first company to go public, but if there is no other listed peer, but is it still catering to the discretionary wallet of the consumer? If it is, then you will give it the broader basket of consumer discretionary and see how some of those companies are traded. another dimension or way to also people look at in cases like this is to see that, what are the growth metrics and margin profile or the return ratios of this company. And, let me look at other companies of similar size, similar, margin profile, and then see how are those valued. Now, see, none of these are necessarily direct answers, but they can all be indications as to, what should be the landing range be. And so for where there is no direct comparable available, you will look at a mix of these 3-4 methods to see what the landing range could be.
Okay, also reminds me, some of these insurance companies, when they listed, I think ICICI Pru was
so Pru Life was the first one. That's absolutely
first
right.
one, yeah. So ICICI Pru. So that's what.
There again, what one used, Ashu, in Pru Life would be, a lot of global examples of listed insurance companies.
Correct.
And Ashu, we had the Just Dial. Sorry, we had the Just Dial IPO, where everyone was struggling. At one point, the regulator had asked us to compare it to Apple, Google, and Microsoft, none of whom were comparable to Just Dial. And then we had to go back and explain, because Just Dial's business was not at all compared. It was a big struggle to justify to the regulator how Just Dial was getting priced.
Yeah, so some of those challenges that companies can also face, it's important to understand that if the business is so unique, where there is no listed peer or no comparable peer. One more question, and Vineet, if you can take this question. Where do you draw the line between Sebi trying to protect the retail investors by wanting to impose more restrictions and compliances on the promoter and institutional investors, which ends up being less incentivizing for them?
Yeah, it's a good question. I mean, practically, there's always a balance between compliance cost, and who bears it compared to protection of retail investors, right? It's interesting, the question itself, because many a times retailers do also, retail investors do also benefit out of issuances, right? But equally, I see the next question in terms of the PDM element, where people are really kind of saying who's really responsible, right? I think it's not an easy answer even for the regulator to kind of say, where do you really draw the line? And it's a bit of a discovery process. Sometimes it does kind of become more onerous for one party compared to the others. But ultimately and holistically, what we're trying to see is Sebi trying to be a little more fairer, bringing more transparency to the process. We've also seen, Sebi become much more active in terms of what requires to be done, how would it be done, what would be those restrictions, right? And bringing accountability to all parties involved in the process. I mean, we've seen auditors face the heat in some of the issuances. We've seen the regulators kind of really being questioned in terms of, is that really happening to an effective process? It's come to the mutual funds in terms of, is there a cartel? What is really happening in that fund structure? So there are all parties in terms of how this is coming together. To me, the proof in the pudding has to be, what is it that the retail investor themselves also take an onus on themselves, right? Which company do you really invest into? Do you see the governance of that company? Because very difficult to draw an over blanket regulation. There has to be a management incentive as well to say how good is that company. And to me, that's really crux of an IPO, because the good companies don't see IPO as the destination. They only see that as the start of the journey themselves, right? Okay. And there's been enough instances, Ashu, where companies have listed at a discount price, and today those prices are 2 times or 3 times, and they're doing subsequent offerings, a much greater dilution at a much higher price. So again, it's a mixed basket to that degree.
Yeah, too many issues to bother about, and one summer does not. Well, I've forgotten whatever the saying is. One last question I'd like to take, and Abhijit, if I can toss this to you. This is, there's a lot of speculation about IPO prices in the gray markets, which is unregulated. Any possibility of Sebi contemplating to regulate these markets as well? These are the unregulated markets, and obviously, there's no particular, I don't know how to describe it, but there's no formal part to it. So why should a regulator want to get into something? When you speak to companies, when you're closer to an IPO, how does it work? What do you tell the companies?
So actually, gray market is an unregulated market, as you rightly said. How can a regulator have a purview on the unregulated market? So he can't have, first of all. And these prices are more like a grapevine than a exchange traded price, where you can go and punch your trade and get the settlement check on T+2. So these are grapevines. Basically, these are more sentimental grapevines that gets into the market, into the ears of people to create the either the hawa of the issue or the bad mouthing of the issue. So I don't think regulator would should and would bother about regulating anything like this. These are just grapevines, and you should look at them like a grapevine, hear them like a grapevine. What is right way to invest is what Satyan said. DRH पे मैं अगर पूरा 500 पेज नहीं पढ़ सकते, it is okay. At least read those first 3 pages.
Yeah. Okay, so also in terms of, so there are some questions also about a DRHP which could be completed quicker about that. Yash, and I'll come first to you, Yash, on that, and then I'll probably go to Satyan on that. Is it needed when you're going through a life-changing experience for the company? Would you ever advise companies, whatever size of those companies and whichever area they are from, to rush through the IPO process, even if you succeed? Or should you take your time and make sure you build a good story and a proper story with the investor?
Sure. Maybe I'll go first, as you requested, Ashu.
Yeah.
So it's in 2 parts, and some other questions also are there, and I want to address it. Disclosure in an IPO document follows 2 broad rules. The first is fair disclosure, which is a global standard of disclosure, that all necessary disclosure is there. So our regulations also provide that. Because see, a regulator can't decide what is, some aspects of the company's business, because obviously you can't cover for everything. But the fair disclosure, what is fair to be disclosed, and our companies have also said that there should be no omission, etc. in the document. The second is the prescriptive nature of our regulation, which is followed by most Asian countries, Hong Kong, Singapore, Vietnam, Malaysia, India. They all follow very prescriptive, because all these countries have gone through huge scams in the last 20, 30 years. So the regulators have said, if you want to do an IPO, you have to check the box. So in your mind, you have to think like you're applying for a passport. When you apply for a passport, if you leave aside some university degree or you've forgotten some other proof, then your passport's not going to come through. So similarly, when you apply to Sebi for the IPO, you need to check a lot of boxes. If you're not checking certain boxes, you need to tell Sebi, I don't have A, B, C, D, E, and this is the reason, right? And Sebi can, in its experience, in its powers, can choose to let it go or ask you to provide it in a different way or whatever. So that's part 1 of the answer. The second part, and I think which people should understand, is that this is not an offering restricted only to India. This offering is made to sophisticated investors in other jurisdictions in the world. So a retail investor in the US can't participate in this because we don't market to retail investors in the US. But qualified institutions in the US, certain class who are like mutual funds, insurance companies, they can participate. Similarly, in the UK, in Hong Kong, in Dubai, Indian issues are marketed to such investors who come and participate, right? There have been instances where issuances by other countries have resulted in litigation. If you rush through this process and you have not given adequate attention to the disclosure, you could be sued. In our country, fortunately, there have been maybe 6-8 cases, but in the US, it is, we keep talking about SPAC. No one discusses. There have been massive litigation after SPACs. There's been a SPAC document, and then there's been a litigation saying all this was not disclosed to me. There have been cases of Chinese companies raising money year after year from 99 to 2014, saying there are forests in China, and there was no forest. And all the lawyers, the bankers, the auditors got litigated against and had to pay a huge fine. The Chinese law firms also sued in the process, right? So there is a risk of people getting sued if they don't do the adequate work. So there is no question of rushing through this. You are taking equity money from investors. All of us as bankers, lawyers, auditors, advisors have a responsibility, and it's intricate. This orchestra which Vineet mentioned, for Sebi, the first person to call is the investment bank. Anything goes wrong, Satyan, come here, explain to me. Then Satyan will call up ENY, Cyril Amarchand, and ask what went wrong. Now explain to me. And now we are seeing fancy industry sections. So Sebi started regulating the industry section, saying, I don't like it. It's too detailed. this total addressable market I don't like, etc. They can ask questions. So the regulator questions everyone which goes through. Registrars who give you shares, they are regulated by Sebi. So every part of the process is intricately linked with responsibility, liability, and obligation to one another. Now, nobody wants to fall afoul for one or two deals, So therefore, there is no question of rushing through. It will take its time. I was told in a meeting in middle of July, we want to file in end August. And everybody on the call was like, yes, we'll make it happen. And I was like, it's not happening for another 3 months. I lost the popularity vote on that call. We filed after much more time. But it is a process. It takes time. If you have prepared, it is like giving an exam. If you have prepared well, you will do the exam well. You can try to do it at the last moment, but the consequences could be dire. So in a country where people give exams and identify with that much better, I just want to put into context that it depends on how well prepared you are, and preparation is key, but it is no question of rushing through. I don't think any reputed organization would ever want to be, as in we at least, and I know others have taken the call that we'd rather withdraw from a transaction than file something which is half-baked. That's very clear for us.
So since Yash mentioned about SPAC setting, there have been some instances of, at least one I can remember immediately, of an Indian company listing in the US through a SPAC, and there have been some other interests. Can you just explain the process for someone looking to do that as well, listing in the overseas markets?
See, one is listing in the overseas market as a company, So per se, I think the current rules do not allow you to go and list overseas till you are listed in India or you do a simultaneous listing. Okay, this is at a company level. We've never seen a simultaneous listing happening, though the rule has always been in existence, because there are a lot of other operating challenges in it. Okay. And yes, we have seen issuances where a company is already listed in India and then they are doing a subsequent, offering as an ADR or whatever for US markets. So that is something that we have seen in the past. With respect to, in the middle, you had seen there was a trend where you had some companies which are basically based in India, but obviously their business was in India, but the holding structure allowed, was overseas, it allowed them to go overseas. And you had seen a set of listings which had happened in the AIMS market. This was the alternate exchange to London, right? And I'm talking about a trend a few years back. So you had 8-10 companies from here that went there. So they got listed. But I always felt that, you will achieve the purpose of calling yourself a listed company, but there is nothing more to it than that out there. Because see, the idea of listing is, there will be trading, there will be market cap creation, there will be multiple things. So a lot of companies that went to AIMS, you had no research coverage, you had no real trading volumes, you had nothing that really happened there. So you had the tick mark of being listed in an exchange, but it did not really serve any purpose because the company, the business, the management all was in India. You had a foreign exchange that you were listed in and nothing happened. Coming to SPACs, see, somehow I have always believed that, a lot of companies that have gone through the SPAC route or wanting to go, see, I think the best desired route is to go through a proper IPO process where disclosure, where everything seemingly is above board, where governance is above board. Okay, because of the detailed document that we spoke about, the DRHP is so detailed; it has everything that is mentioned. Somehow SPAC has had that connotation that, look, is there something which is not, is everything above board, or is there something that is, why isn't the company going public in the normal route? Why are they going through the SPAC route? And we, really speaking, yes, there are 1 or 2 examples of companies who have gone and done that. But you will not find, if you see most companies, you never associate that with most frontline companies that have, typically gone and taken that route. Because there is always this one big feeling of, is everything above board? It's going through that route versus, going through the normal. Why would a company not go through the normal route of getting listed?
So some challenges definitely with a SPAC there, but so for a company then Abhijit, which has the scale and wants to list in the US or list in a larger market, whether it's a proper London Stock Exchange or a New York Stock Exchange or even a NASDAQ there in the US. What are the options, if you could spell that out, if you may have advised any of your clients or potential clients?
So there are a couple of companies who explored that as an opportunity to get listed overseas. But soon they realized that if their consumer base is into India, and the valuation that a company gets, actually PE has two facets to it. One is the performance, which is more mathematical, and second is a perception, which is very subjective. And perception is what people see around them, and that is how they would want to value. So if I can mention some of the names like Policy Bazaar, or for that matter Zomato, who explored an opportunity to invest themselves overseas, realize that Zomato in USA will be just one more Zomato for them, while Zomato in India is where people will be able to associate themselves with that company, and thereby will get a very different valuation. And so is the case with Policy Bazaar. So while there are a lot of opportunities, and companies in the past have explored those opportunities, but now have realized that investing where your real consumer base is makes more sense than going abroad and trying to explore that. If
So
I have answered your question.
Yeah, so I get the larger picture. So Yash, how differently do companies need to approach the documentation, the legal detailing part, if they are looking to list overseas, SPAC or no SPAC?
Sure. So, I think for a moment, one should just step back and see what a SPAC is. A SPAC is it's a listed fund. It's a blank check company. It's a bunch of people who come together just because they they think Satya and Abhijit are great fund managers. They put together, say, 100 crores. Now, in a particular period of time, 12 to 18 months mostly, Satya and Abhijit have to find a company around the world and merge it into the SPAC. Okay. And in India, you can't merge an Indian company into a US company. That's just not possible. So you go through a complex structure. And as both Abhijit and Satyan have said, it's done for a variety of reasons, but you don't really enjoy the company's growth. And really, it's not a listing of the same shareholders, etc. Because remember, there's already a bunch of people who've invested in that fund. They plus the existing investors become shareholders, and it sort of lists. It continues to go on. It's already listed. So I think that's very different. The disclosure standards of a SPAC are quite high. However, whilst we acted for Renew and we followed pretty much the same standard, there have been a bunch of litigation where people have said that a lot of disclosure was not made properly. There is already ongoing litigation in the US. However, if you do a more vanilla, the kind Satyan mentioned for, say, a Make My Trip, which is largely Indian operations, but where the structure is overseas, and again, those also we are seeing 4, 5. We are working on some. The standard there is far higher. Again, there is a slight difference between the SEC and Sebi, as in the US has had a lot of enforcement on poor disclosure. So there is genuine fear of making poor disclosure and of leaving out. And they've followed fair disclosure as a norm, but not being too specific that I want to know your date of birth, which university you went to. All that detail is not necessary in a US file. In an Indian filing, this is all part of the regulation. They want to have a fair bit of detail. The regulator has gone through a lot of experiences before forming the regulation. So therefore, the detailing in the Indian document is far higher. If you cull out the detailing, the documents are going to look fairly similar now. The 3 years versus 5 year financials, which Vineet said is now equal. Globally is 3, in India is 3. In terms of that, IFRS global is a good standard. India is very similar. MD&A business, all very similar. So when we've been doing all these IPOs like a Zomato or a Nykaa or a Policy Bazaar, we've looked at their peers in the US, and the documents have been very comparable, not at all differentiated. The US has a little more flexibility on some fronts. You will see, for example, if you open the IPO document of DoorDash, which is the equivalent of Zomato, there's a beautiful letter written by the founder saying, when I was growing up, I smelled the food in my mother's kitchen and I felt I should deliver food. So you won't see that in Indian document and etc. And there are differences. But I think quality-wise, substance-wise, it is comparable. It is absolutely comparable. There is though fear in the US of litigation, of missing out some things. And there used to be some, when I did an EDR some year, 10 years back called Sterlite, and where the US was like, diligence was a little lower, I felt. But I think when I'm doing deals now in the US, they've also had the same diligence standard, backup standard. So securities laws across the world is more or less on an even keel now. And I think it's institutional investor driven. The investor is the same, whether based, whether you're issuing securities out of India, China, Hong Kong, UK, or the US, the investors are same. So they want similar levels of disclosure. So you will find that the US documents are thinner. But as I said, if you take an Indian offer document and out of the 500, you remove that, I studied in Harvard, I studied in Jumri Law College, you remove all that and you'll see it almost sounds the same.
And a copy of Aadhaar as well, which everyone insists.
Yeah, the Aadhaar and PAN card. And not to forget details of all the other companies you hold shares in, and I could go on. Sorry.
Oh, yeah. Vineet, in terms of companies wanting to now tap the markets, when you speak to some of those companies, what is the desire there from companies? When I use the word desire, I mean to say, in terms of how do they want to see themselves post-listing? If you tell them that, look, it could take about 6 to, let's say, 12 months, what is their dream to be?
Ashu, coming across, two really discrete set of companies, right? One set of companies are really those when markets are great. We really want to press everything, all buttons, let's go hell blazing. What is the earliest we can file, right? We really want to take advantage of the markets. Equally, I'm coming across those companies which are saying, we'd want to file the document, not today, not in the next year, but tell me sometime late 2022, sometime early 23, what could we do to prepare better, right? How can we be better organized, right? This has been the ethos of our company, right? We don't have much borrowings, we good growth capital. This is what we want to see. This is our mindset. This is the way we would like to operate, right? And in each of those kind of scenarios, the answer is fairly different, right? Some of these companies which are, thinking about taking advantage to a degree of other matter are ready to a degree because they've been thinking earlier. They've been thinking a year ago that they want to tap the markets today. Right? So, or for that matter, is the right answer for them compared to where they are in their own lifespan. Right? These companies are really saying, I'm ready from a governance perspective. We're aware of some of the challenges in a post-listing scenario. And I tell them, the common scenario, that unite the two, it's a very different analogy. It's like, think about like a wedding, right? Imagine an Indian wedding where you have, all the music and dance and, amazing food, and it's all glorious, right? But a wedding is very different to a marriage, right? Because after day 2, after 1 month, after 5 years, after 20 years, that analogy of a marriage and a wedding are two very different things. And to me, life post-listing to a degree also alludes to that. It's about the transparency, the accountability, the honesty. It's about the promises you made to each other, right? Whether I'm talking about the investors and to individuals, right? Is that correlation to a degree to say, how do we bring that together? And then ultimately, those companies that really succeed, which are well prepared, to a degree, I mean, to Yash's point earlier, in some cases, the Indian regulators are more stringent than some of the global ones. Our stub periods are required numbers to be audited, right? That doesn't happen much globally, right? So to that degree, it's about the well-governed companies. It's about how do you tap it, and we've seen that the way the framework is, those companies which are not very prepared, they might start, they might do all the process, but they soon lose the steam out, right? Towards the end, they'll be like, oh, we run behind on some issue or a new issue has been cropped up, and there'll be some issue in the span works, and it derails the process to a degree. Whereas there are other companies which have started the process 6 months ago. They've thought through the long lead items. They've gone through step by step. How would the cap structure be? How would the financials be? What would my board look like? Am I ready from a post-listing scenario? What about my prevention of insider trading? How are we going to totally comply with all regulations? So I think it's just, as far as, there's no right answer to it, but it's just bringing it all together.
Okay, it's so interesting to hear from you, Vineet. Today you're on a roll because you're speaking of weddings, you've spoken of the orchestra, you're talking of food, you're talking of marriage. God, what a day you're having. Wonderful to hear that. So from the regulator's point also, Abhijit, want to understand, what are when a company goes to a regulator with the intent, what are some of the things they should be very careful about what is being disclosed to a regulator? And what, if you can specifically mention, are a complete no-no, absolutely companies should not be doing it?
I mean, if there are aspects that are completely no to be showcasing it to regulator, then that company should not think about doing IPO. First of all.
So what are some of those items? So if you can probably mention, so it could be about, the finances or the financial statements not being in order, let's say quarter by quarter or something like that. What could they be?
I mean, financial statements not in order we can get them in order. I mean, Vineet is there and there are other companies who will help them in getting them into order. But if there are some criminal proceedings in the past, and if you don't want to disclose and you want to hide them behind something, then I think you should not consider going IPO, because eventually it is going to be out in public domain. So from that perspective, and market is evolving. So while a lot of retail and HNI do depend on the institutional players for them, because when the anchor book gets filled, it is like an ISO 9000, because those are the people considered to be a professional investor, would have spent some time with the promoters, would have understood, would have read something, would have done the analysis themselves on the industry and things like that. So from that perspective, I think people do depend on the professional investors. But if you cannot cross the hump of the professional investor in terms of your disclosures and their analysis, then those companies are not even worth pursuing, is what I think. I may have too vehement, but I don't know.
Okay, get the point. And there's also another question that has come in, and this Vishal Maheshwari, he almost has spoken my mind, and he asks, can you throw some light on SME IPO timeframe and the bandwidth to the same bandwidth to do the same? I guess that's what he wants to. Second, SMEs and IPO, the exchanges for SMA really has not taken off in a very big way in India. That's been one of the sore points for in terms of regulation. What, in terms of the question that the gentleman had, Mr. Maheshwari, can you throw some light on it?
I think, to be fair, we as a house do not deal in SME IPOs.
Oops. Okay.
So maybe I'm not the best equipped person to answer that question for him in terms of the process and the timeline. But yes, it's not taken off in the manner that, as you rightly pointed out, in the manner one desired. And one does feel that, with market caps overall rising, there is this big gap. There are companies that are really small who should not go public or cannot go public, and some of them are still going through the SME route, and there are large companies that are larger, but a classic company which is going to result in, say, 1,000 crore market cap today, it's too big for SME and it's too small for the main board. And where do they go? A company that, a promoter and entrepreneur that wants to raise capital. Sorry, I'm not answering the question that you raised, but I'm posing a different question. Yes, I think there is that gap. Traditionally they can go to the main board, but in the main board today, most people want to have a certain threshold of market cap, at least institutional investors, before they come in. And companies in that 800 to 1,000 crore companies, will kind of struggle, because there is a main board where most investors are not wanting to look at it and they are too big for SME. So you also have a gap for that. But I think on SME, I don't know if Yash or Vineet have an answer to it, but I may not be the best person to answer that.
Yes, sure.
Vineet raised his hand, yeah.
Okay. Let Vineet take the question. Vineet, SME IPOs challenges.
Yeah, I mean, there are pros and cons in SME in the main. I mean, first and foremost, the SME exchange, I'm just laying the basic out, it doesn't require a Sebi review. It's an exchange review of the document per se, right? That kind of reduces the time frame. Secondly, from a gap perspective, Indian gaps, acceptable. That's there. The exchanges, in terms of the companies which are coming on the exchange, the issue of capital, is much lesser compared to the main market. So to that degree, the SME market has come. The reason it's not really flourished as much as the others. Time frame, as I mentioned, it's shorter. A main board is more 6 months. SME is half of that practically. Bandwidth per se, there's a really different set of advisors that the SME market is working on. Right? The issue size is typically more about the sub 150 crore. So you could have 8, 10, 20, 50, 100 crore kind of size compared to the main board exchanges. Right? That itself means that there's the other important principally difference between the two is on the main board you can change exchange hands on per share basis. In one single share can be traded, whereas in the SME it is in lots. So a lot of 50, 100, 200, whatever those lots may be, and therefore it's more block trading as opposed to individual share trading. One of the main reasons why also perhaps the Indian market is slightly different compared to global is on the SME front. The institutional investors, right? The liquidity has not been as flowing through as compared to the main board. So that's some of the drawbacks and pros and cons. Equally, there are a number of companies on the SME exchange which have done really well. They have migrated onto the main board. So it's really seeing the SME exchange as a stepping stone to the main market listing. The reason some of the investors have probably not made a very informed decision and invested in the SMEs have really burned their hands and probably added a bit more negative color to it. But it is overall a good stepping stone into a main board, depending on the factors that we need to consider. But I mean, I'll let Yash or Abhijit add to what I've said, please.
Yash, would you like to add anything?
No, I think we need to summarize it well. Again, like Satyen, we don't advise on a lot of SME IPOs, unfortunately. We did attempt one a few years back and we weren't successful. That company didn't list. So if Abhijit wants to take that up, but I apologize, I'm not.
No worries. No worries.
Same thing with us. We don't advise on the SME IPOs. But Vinit said it very well. I mean, it's a stepping stone to the main board. But there haven't been many successful stories which have managed that.
It just reminds me of some of the Indian smaller companies listing on the alternative investment market in London. And of course, there's some controversy around that as well. So anyway, some things keep happening in history. There's another question coming for you, Yash, looks like. Why is high profits made by private equity investors by sale of shares in an IPO a concern for Sebi, says Vanshika Singh. Why does Sebi think there is a need for merchant bankers to state the cost of acquisition of large investors like PE in IPS advertisements? Yash?
So again, a lot of private equity investors came in when the company was unlisted, and they may have come in 2, 5, 7 years back. As Satyen and others explained, the last 12, 18 months have been phenomenal for some of these companies who've seen a lot of growth. The Nikas of the world, the Zomatos, all of us have changed the way we order things around. People came in at an early time. The company's grown. Today they're selling. So they paid X and they're now getting 3X, 4X, 5X. So there has been a lot of value creation. So Sebi wants people to disclose the price at which they've come and the profit they're making. I am not sure how it's going to affect investor sentiment. I think most investors are aware. I think the flip to this, which people should appreciate, is there are a lot of other companies where the X has become zero. So the same investors have invested in other companies and the companies have just gone completely down the drain. And this is also third-party money. The large institutional investors who invest in these companies, it's not their own money. They're investing other people's money. So it's disclosure, but again, there are willing people, willing buyer, willing seller, caveat emptor. So it's better disclosure. I'm not sure it makes a big difference to see that, because if someone came in Nika in 2011 versus somebody who comes in 21, Nika was just being set up in 2010, 11, 12, right? There's obviously going to be some risk you take. There must have been another 100 companies who were incorporated in 2011, 12, and who have ceased to exist today. So, and investors lost everything in those companies. So I think that's at least my thought process, but I don't know if the other panelists have thoughts on why Sebi wants this disclosure and how it will help investors. It's not very clear to me, unfortunately.
Satyen?
I think absolutely fair. Yash, my sense is, Sebi asking for it is more coming from their overall view that, if more disclosure helps in people taking an informed decision. Should we, facilitate that? So currently also your offer document anyway in the capital structure build-up section has all the issuances, past issuances that the company has done and at what price. So that detailed info is anyway available. By putting it in the advertisement, I think they are just trying to play the role that, would giving that disclosure, does it help people taking a more informed decision that yes, XYZ fund is making X return. But, on a lighter note, see, I think what also happens is, on one hand, we want to question this or we want to ask for this. Maybe somebody should also question, right, that what changed in Nykaa in 7 days that the IPO price has doubled. I'm saying when it's in plus or when it's in green, it's oh, that's a great decision that we've made in investing. But why would the valuation double in 7 days time, right? But I mean, I'm just saying that on a lighter note. But obviously, when something goes down and somebody loses money, I think there are more questions put out. But my answer to this currently is I think it's more Sebi's view of just giving more disclosure so that somebody makes a more informed choice, just to facilitate that.
And there were also people complaining when the IRCTC IPO that turned out to be a rockstar IPO.
Correct.
And there were quite a few people who were not very happy with that.
Correct.
We've heard of those stories. Yeah. So Vineet, just to sum up the whole thing, for companies which are dreaming of an IPO, for companies which want their stocks to trade in one of the stock markets in India, how would you say that they should, well, you mentioned about the 6-month period, but obviously if they start today, some of the preparatory work has to be done before they come to the starting line. Those initial period, if you can also mention, what would that entail? What kind of work would that entail?
Sure. I mean, Ashwit, I will break this down into 4 key components per se. Okay. First and foremost is the cap structure of the company, right? In terms of the number of shares that they have, right? Do they need to do a bonus issue, a split? Ultimately, at what price would you want to list is a factor of the valuation per se. Linked to the cap structure is also the organization structure of the company, right? What is my core assets? Is there any divestitures that we need to do? What is the structuring that we need to do on the same? Really getting that structure together of the company per se. So that's your cap structure and the organization structure of the company. Second is your financial statements, because once you know your group perimeter, you have those numbers to demonstrate your track record. Those numbers need to be 3 years in days. It's a stated fact. Now, even if I'm doing an IPO next year in September 22, I know that 2 years have already gone behind me. Let me start that work of the restatement of the 3 years. Right? Get the work done, whatever can be done. Right? Also prepare your finance function, because what happens is these companies, typically, irrespective of how they run and who owns the management, many times the finance function is not the attention. Right? Somebody told me that, it's about, we can do it, but it's not been our attention because our attention have been on the growth of the business. So some of the infrastructure, therefore, is a lag to where it's required compared to a listed company. Making those investments early and thinking that, a 1% change in the valuation multiple, if it's a P of 13 to 14, would actually pay all the cost for it. Right? Thinking with that mindset would really get the structure of the finance function together, and thinking, I need to, as a listed company, prepare my numbers, have to have quarterlies, comparatives, and all that done. So we as well do it today, irrespective of who your investor is going to be, whether they do an IPO or you go for somebody else as an investor. Third and foremost, and Yash could add to that, is, many of the law firms who come on board, they'll do a very thorough job of legal diligence that needs to be done. For that, practically from the inception of the company through to the date of the filing of the document with Sebi, all of that diligence has to happen. Get your virtual data room in order. Right? There are companies which not even start the process. You go in the hurrah and you just press button, you do a kickoff meeting, but there's no data room to even diligence. And the company just simply lost 3 weeks after the process. Financials become stale because the 135 that Yash was talking about, and you're just playing a catch-up game. Right? I'll bring the fourth analogy, Ashu. I don't know, I'm in that mood today to share analogies. It's like the train on the platform. Right? Would you want to wait on the platform, or would you want to run behind a train which has already left the platform? Right? It's a very easy decision to make on that front. Lastly, have a conductor like me in the company itself, run through the process, make sure you got all ends tied up. Look at what Abhijit would bring in. Is there private equity governance that's required before your IPO, or is it IPO able as a company, make the right strategic decision from a valuation perspective. And I would just practically break into those four buckets. To summarize, have your governance and board in place, have the financials, know which structure it is, have your legal diligence in the data room together, and then think about live post listing in terms of investor relations, your communications to market, and catch the train on the platform.
Okay, so today certainly you're in the mood for analogies today. Abhijit, quick one on the way markets would perceive anything missing, any of these key things missing, even if the IPO gets a nod from the regulator.
So what happens is that, as I spoke a little while ago, that P is made up of two things: performance and perception. In the short term, things might get missed out of investors' sight, but in the long term, all of them surface. So definitely, to answer your question is that whether in the long term the same valuation will remain, they will not remain. It might happen that regulator, while assessing and testing the DRHP, may miss on something, but eventually those things will surface. So from the perspective of crossing the hump of regulator, you would, but eventually you will not be able to cross the hump of investors.
That's the ultimate test, of course. Satin, any last words?
So I think in one of the questions also, I did read that, how does one prepare for a smooth preparation or early preparation of, DRHP, or how do you shorten the time? So I think, again, and we need touched upon what we call long lead items right at the beginning of the session. So I would say that, if you want to shorten the time for DRHP or getting ready, so there are 3-4 big things that you can start off much earlier before you really formally start the process. And, these are the things that really are time consuming or will take maximum amount of bandwidth, time, effort to fix. So one is the entire audit part, because there is a certain prescribed format of Sebi, from a 3-year perspective also, how they like to look at accounts. So audit takes time as you are preparing, because you need to give consolidated, restated, audited accounts. So that is one. Second is the entire legal section. So there is a requirement from Sebi that all litigation by or against the company, by or against the promoters, or by or against the directors has to find mention in the document. You have to make a disclosure about it. And many a times this is a very time consuming thing, because, a company having multiple branches, many times litigation is not at the company level or at the head office level. It's a more branch specific thing. And, if it is, not centralized, you may have litigation in some branch which you're not aware of, and it misses, putting that in the document. So this is normally a big time consuming thing. So that's one thing that companies can get started early. Third is the entire composition of the board. There is a certain requirement of having independent directors basis, whether the chairman is executive or non-executive. So your independent directors will vary from 50% to 33%. And, getting those independent directors on board, this is a key requirement before DRHP filing. And again, getting the right board of directors, because you'll also need their disclosures and their litigation and all to be put up, is a very time consuming thing. So again, if you know that you want to go public over the next, 6 months, these are things that you can really start early on. And lastly, if I were to put, again, we've spoken about is the whole cap structure and who will be defined as promoters. So these are the 3-4 big areas that normally consume time. And my advice would be that anybody planning to go public, these are things that you can really start working on much earlier, so that your actual time is reasonably shortened once you are in the formal process mode.
Okay. Yash, I'd leave the last words to you, and maybe I'm sure you have one interesting anecdote which you can say without mentioning any companies, if you can.
No, I think a lot has been said over the last hour and a half. Preparation is the key. Preparation is the key. There have been many companies who have floundered along the way because they've not been well prepared. And in terms of an anecdote, for the Embassy REIT, we took 5 years. We started in 2013 and we IPO'd the REIT in 2018. So it was the first REIT. If you are patient, there is always a right time, but don't try to chase, it's not like you have to do an IPO today. There will be a right time, there will be a right valuation. There are other companies who I've worked with from 2007-8 who got listed relatively recently, but who are now enjoying great valuation and doing very well in the market. So patience is key. Don't try to time the market. It is always going to catch you, catch you out. That would be something I would recommend.
Okay. Patience never goes unrewarded, if I were to probably try and sum it up for the IPO and what could be the blueprint for an IPO. Thank you so much for watching. It's been interesting times, so many IPOs, so many newer opportunities, and so many more companies, hopefully, trying to go the IPO route. Gentlemen, thank you so much for being with us. Wonderful speaking to you all.